Hi guys, and welcome to my channel. Today we'll be talking about investing in stocks for beginners. So this video is really aimed at who have never invested in stocks before and are looking to start from scratch. Right, so before we go into how to invest in stocks, I think it's worthwhile touching upon where to invest. If you've never invested before, it's a very valid question to ask. How do you invest in stocks? How can you invest in stocks? And what platforms to use. Traditionally, these used to be done using what's called share certificates. So you'd have a stockbroker in the middle who would deal these share certificates for you, issue these for you, and also look after all the dividends, etc., that you were owed. Clearly, we live in a tech-friendly environment these days, so we've got plenty of different investing platforms that you can now use to invest in stocks at the click of a button. It's also worth mentioning that this video is about stock picking and how to select stocks to invest in, but it's worth mentioning that sometimes people are not always aware that another option they have is fund investment. There's lots more we can go into this, and I will do in a separate video, but suffice to know for now that funds can be passive or active. Passive meaning that you can invest in a fund that tracks an index, so it doesn't add any alpha or value in terms of additional returns. It just does what the index does. And the other kind is active, where the fund manager will have a view on certain investment decisions and deviate away from the index that it's benchmarked to. So first thing you need to do before you start investing is form a view. Have a view on the markets. You don't have to have a finance degree to form a view. And what do I mean when I say form a view? So have an opinion on where you think the markets are going. This doesn't have to take the form of rocket science. So it's just very simple things like, do you think banks are going to cut rates or raise rates? What do you think the oil price is going to do? Has there been a escalation in the trade wars? Do you think it's going to impact the import and export numbers in the country? What about supermarkets? Are they suffering from technology and Amazonification of supermarket chains? So just start building an opinion on where you think various aspects of the markets are going. Okay, so next up, now that we've got our investment platform sorted, we've started to have an opinion on where the markets are. I think now is when we can start talking about how you're going to approach investing in stocks. So first things first, there's two basic approaches to stock investment. And this is actually what they're called in the finance field as well. So top down, as the name states, looks upon investing in a more holistic manner, or it starts off at least with a more holistic manner. So it looks at the macro meaning the economics of the world. So what's the oil price doing? What's the impact of trade wars? How's the economy performing? Where are the rates? What's the inflation rate? Those kind of questions. And then it forms a view. So I'll give you an example. So you think that rates are going to continue to remain lower for longer. So what does that mean? Well, that means that banks, which make that money by charging customers on their mortgages, charging rates to customers on their mortgages, will probably suffer because they won't be able to charge higher rates, because the mortgage rates are linked to rates set by the central banks. So if the rates aren't going to rise, surely the mortgage rates won't rise, which means the banks won't make much money. It won't be good for banks. I mean, that's a very simplistic approach, but generally, yes, lower rates aren't meant to be good for banks, and there's a more kind of detail behind it, but the gist of it is that banks suffer when rates are lower, so that kind of environment is not good for banks. Okay, now sticking to the same example, what if you were to expect rates to go up? And it's a good buy. So because it's a top-down approach, obviously I'm not going into the full detail of how the analysis should be, how you would come down to the stock selection itself. I'm just going through the very rough stages. So in a top-down approach, as you can see, you first start off with the world economy. So how are rates expected to perform? They're expected to go up. Fine, that means banks should do well. Fine. The next stage would be, honing in on the banks. So, let's take an example. What banks have we got in the UK? So let's say Lloyds, RBS, HSBC. So that's your third step down. You now go into each of these banks and have a bit of look into their balance sheets, their performance, how have they performed in the past. Is the share price looking particularly cheap versus where it's been in the past? Have there been regulatory changes that impacted one bank more than the other? What about profit margins and revenues? How have they been doing on that front? So you've now come down to closer to the final stages. You want to buy a bank, you think that sector will be profitable. So now is the stage where you make a decision on which bank you're going to go for. Okay, so the next type of approach to investing in stocks is a bottom-up approach. So here you don't start off with thinking how rates are going to go and what impact that will have on which sector and which stocks within that sector tend to stand out as an attractive buy, but it's the other way around. So here I'm using an example of Tesco's. So you've been paying attention to Tesco's. They've issued their recent earnings that seems to have come out quite positive, strong earnings. So you think Tesco is doing quite well, and you've been researching the stock, so you know that it's in a pretty healthy position. So now you go one step up and look at supermarkets in general. So Tesco as a company is doing well, great. But what about supermarkets in general? How have they performed, over the past few years? What's the trend likely to look like over the coming years? Are there any headwinds that we should be aware of? Meaning, are there any issues that might cause concerns? What's the UK GDP looking like? Are we close to a recession? Does that mean people are generally going to shop less? But is that going to have an impact on a supermarket chain like Tesco? What about technology? How much of an impact is technology and online shopping having on Tesco's? So in a nutshell, that's, as you can see, hopefully, that's a complete different approach to what we talked about before, which was the top-down approach. So two different approaches. You may and you should really come down to the same stocks if you've done your analysis well. Okay, so the next thing we'll be discussing is the types of stocks there are. Now, there are various different ways in which you can categorize stocks, and we're going to talk about a few of those today. So the first thing is sectors. So how can you categorize stocks into various different sectors and subsectors? Types of stocks, regions, factors. Now, these are only 4 that I've mentioned here and we'll touch upon, but as I said before, there are various other ways to categorize stocks as well. So let's start with the first one, sectors and subsectors. So I'm going to break these down into 3 broad subsectors, and this is defined publicly by Morningstar. It's 3 different sectors. There are other organizations that sometimes only classify stocks into 2 sectors, defensive and cyclicals, but for the purpose of this presentation, we're going to go with the Morningstar way of sector identification. And there's 3 different sectors: defensive, cyclical, and super sensitive. So it's what it says on the tin, really. So defensive sector would include subsectors such as utilities and healthcare. Now, why is that? Companies in the utility space or in the healthcare space aren't going to see that much fluctuation in revenue streams because people are going to go to hospitals whether it's a recession or not. People are going to need to pay their energy bills whether it's a recession or not. Of course, they will be impacted to a certain extent, but people will still demand water and they will still demand healthcare services. So they're fairly defensive sectors. Cyclical sectors are those such as financials, that work in cycles. If I think we touched upon rates earlier, so if it's a cycle whereby rates are low in the country, banks and financial companies in general tend to suffer. Real estate, again, it has a link to inflation. And it works in cycles. Sometimes property prices are high, other times it's not. It really depends and is driven by the GDP and the business cycle we're in. Sensitive, this actually includes subsectors such as energy. Oil price moves and you will see a direct impact on some of the oil companies such as BP, Shell. So these are really sensitive sectors that are impacted very. tend to be linked to commodities and price change in commodities, which can be quite volatile, hence the sensitivity in the share price as well. Next, we're going to speak about the various factors and how you can break stocks down into factors. So again, there's various different other factors that we can talk about, but over here we'll be touching upon 3 factors and keeping it very, very simple. So say we have 3 different ways to break stocks down into value, growth, and size. Now, what does value mean? Value simplistically means that you're buying the stock when it's cheap. So a technical measure of the cheapness or relative cheapness of the stock would be what's called the PE or price to earnings ratio, but we're not going to go into too much detail in this video. So if a share price has been high in the past and it's reached a trough in the share price because of some external reason, or it might even be internal reason, mismanagement of the company, but you know that things are going to change. So there is going to be a change in management and the new management have a nice strong 5-year plan that they're working towards. So in that example, it's a cheap stock because you believe in the stock, but the price has just fallen due to reasons that you think are recoverable. Next is growth stocks. So these are fast-paced stocks, stocks that grow really fast, like technology stocks have grown massively over the past few years. And finally, size. So these are companies that give you a premium because they are not large in size. So if you invest a smaller company, you should expect to get a higher premium because they are smaller and therefore less liquid. And again, small caps don't always do better than large caps. So you need to it with the research fully done. Right, so that was basically. Finally, we'll be touching upon regions, and one thing to be careful of here is regions versus regional exposure, and I'll give you a prime example of this. A stock called Philip Morris. So Philip Morris is a tobacco stock, and it's if you talk about the regions, it's a US stock. The company is based in the US. However, the regional exposure that it has is mainly in emerging markets because most of the sales, it sells globally, but most of the sales for Philip Morris, for example, come from EM, emerging markets. So you need to be aware of the conditions in both emerging markets and the US if you're invested in a stock such as that. So it's very important to make sure you know the difference between the two. Basically it from me, guys. Thank you so much for watching the video. Please don't forget to like and subscribe below. I will be providing market updates on a weekly basis, or possibly more often than that even. So do like and subscribe below to keep up with what's going on in the markets, my stock picks and various other videos to come. If there are any specific requests for videos, please don't forget to drop a comment in the box below and I will try my best to do a video on that. Thanks guys, goodbye.